Good morning, everybody. CGS CIMB Thailand would like to welcome you to our special event this morning. It's a great pleasure for me to introduce our speaker, who is going to enlighten us on Singapore bank stocks, resilient long-term dividend growers. Mr. Alvin Chow, who is our speaker today, is the CEO of Dr.Wealth. So Dr.Wealth is a financial education company that aims to level up the financial literacy of individuals via courses, articles, and videos. He graduated with an engineering degree from Nanyang Technological University or NTU and was a Singapore Armed Force or SAF academic training award holder. After serving the SAF for 6 years, he co-founded Dr.Wealth to pursue his interest in investing. He has been investing and writing publicly about the markets since 2007 and has trained over 5,000 individuals over a span of 7 years. Mr. Chow believes that the stock market is one of the best avenues to grow one's wealth, and more Singaporeans should allocate parts of their net worth in stocks. He started Dr.Wealth to educate individuals on stock investing and using factors to pick stocks that are more likely to outperform the markets. He has also been invited to speak at events organized by Stock Exchange of Singapore or SGX, shareholders, investors, and more, and appear in major media outlets such as CNA, Channel News Asia, and Money FM 89.3 in Singapore. Besides conducting training at Dr.Wealth, he is also an SGX Academy trainer and does pro bono talks to employees in corporations and school in his own capacity. So for the topic today, we'll cover Singapore banks. Singapore banks have weathered crises such as the Asian financial crisis in 1997, known as the Tom Yam Goong crisis, and the Great Financial Crisis in 2008. Many lessons were learned, and banks have emerged stronger over the years. DBS, OCBC, UOB have been able to distribute dividend every year for the last 20 years, and the dividend per share has been raised on several occasions. They make a good long-term steady dividend investment when bought at attractive prices. Our speaker, Mr. Alvin Chow, will share the idea on how investors can analyze bank stock and how to determine if they are undervalued. He will also be covering important metrics to establish a financial standing for banks. So let me pass the scene to Alvin Chow. Welcome, Alvin. Good morning.
Hi, good morning. I hope you guys can hear me.
Sure, we do.
Okay, let me share my screen. Are you able to see it too?
Yep. I think it's coming in. Yeah, I should be able to up on screen quite soon.
Right, great.
There you go.
Thank you, Konsin, for the introduction. And I'm Alvin, and I'm happy to speak to my friends in Thailand. Right, so today I'm going to share about Singapore bank stocks. I'm not sure how many of you are familiar with it, but along the way, if you have any questions, just please feel free to type it in. I'll address them at the end of the presentation, right? So that you can get your questions answered as well, not just listening to what I've prepared. So the scope of today is simple. So I'll break it down into two parts actually. The first part, we will analyze the bank stocks, and this can be used beyond Singapore banks. That means you can use it to analyze Thai banks, you can use it to analyze US banks. These metrics are very generic for bank stocks, and they apply to anywhere in the world. Right? And then the second part, we'll zoom in more into the Singapore banks, how I'll use some of these metrics that I've shared with you and apply them to analyzing Singapore banks. And lastly will be the Q&A. just type in your questions. I'll answer them at the end. Okay, so the bank business model, I guess, is not something that is difficult. Every one of us use the bank, right? And this the bank probably made money through many ways from us. So it could be when we borrow money from the bank, right? So we pay with interest. It could be we swipe credit cards, there are transaction fees, and they also take some fees from the merchant as well, not just from the consumers. And if you buy any wealth management products, they will have sales commission or even trailer fees from the managers, fund managers, right? They also can serve as trustee, and they collect this kind of trustee fees as well, right? And credit card interest. So these are just some of the revenue streams that a bank may have. But they may be more investment banking, then they will have other kind of M&A deal fees. So banks would also have different kind of business segments that they can focus on. All right. So roughly, that is the sense of how the bank business model is, and is a very advantageous position because they sit at the center of the capitalistic society. Right, so that means almost anything that related to money flow, transaction, investment, they will take a cut of it. So that's why a lot of investors like banks. There are some key things that you should know about banks. One of the key metric will be the net interest margin, right? Net interest margin, or NIM in short. You understand how the bank works, right? So they collect money, they collect deposit from the depositor, right? Okay, so they pay interest to the depositor, and you and I know that if you just put your money or cash in a bank account, it gets very little interest, right? The interest paid is quite low, and then after that, after they take the money from you, they will lend it out to other borrowers. It could be other people who wants to borrow the money to buy a house, or they may want to borrow money to start a business, right? So those are the borrower, and in return, the bank gets an interest. Right? So they just need to make sure that the interest that they charge is higher than the interest that they pay. And essentially, that is the simplified explanation of what a net interest margin is. You want the difference to be as large as possible so that they are able to make more money for themselves. Right? So that's the very first key metric that you should know. And the second key metric is called the non-performing loan. And there is a risk when a bank lend out money because the borrower may not be able to repay as per agreed schedule, right? So if let's say a borrower has not repaid the principal plus interest for a period of time, then the bank may classify that loan as a non-performing loan. That it has not been defaulted yet, just that they missed the payments, right? And it depends on how the bank define what periods is considered a non-performing loan. Okay, so of course you want a bank to have very low rates of non-performing loan, and if your bank has a lot of high rate of non-performing loan, that means the chances of the borrower defaulting and the bank having to write off debts will be much higher. All right, and if a crisis hit, then a bank with a very high non-performing loan will suffer even more. Okay, so this is another key metric, the second key metric that you should know about banks. The third key metric is the capital adequacy ratio. So how does a bank works is that the amazing thing is that banks are leveraged. Okay, so we talk about the depositors, right? So deposit money, and then the bank will have some cash reserve, and they will lend it out, right? They will lend it out, and some can be risky assets, which we talk about. The chances of getting non-performing loans ratio up, it could be one of them. All right, and the thing about banks is that if let's say somebody deposit like $1, they can actually lend out $10. Okay, so there is that leverage that is embedded in a bank system, right? But of course, if they lend out too much and they have too little reserve, they may risk a bank run. That means if a lot of people try to withdraw money, they couldn't because there's not enough reserve, then the bank will run into a problem, right? Run into liquidity issues, all right? So this capital adequacy ratio is just to ensure that the bank has enough reserve in case some of these risky assets default, right? And they can't pay back the bank, and that is the bank will have to continue operating because there are depositors who may want to withdraw money, right? So they have to make sure that they maintain enough capital in the case of to prevent any bank runs that's going to happen to them, right? So that is a capital adequacy ratio. Different countries may impose different levels of capital adequacy ratio, and you want this capital adequacy ratio to be enough, right? Not too low. Too low is too risky. Too high, then it may not be efficient for the bank to make enough money off the loans, right? So I think as long as they comply with the minimum amount and they just go slightly above, I think that's good enough. Okay, so then the fourth thing is that we talk about valuation, right? There are many ways that you can value a bank, but I will just share with you the simplest way, which I think is effective enough, and that's using the price to book ratio, right? Price to book ratio. I'm not sure how many of you are familiar with this. This is a very classic metric that is used by value investors, right? You want to buy when the price to book ratio is low. That means it is cheap. Okay, if the price to book ratio is high, means it is expensive. The thing about this price to book value ratio, it cannot be used in all stocks, right? So for example, for technology stocks where they don't have a lot of assets, their book value is not valuable per se, because they are usually very asset light. Most of their value comes in the form of intangible assets, which may not be valued properly in the balance sheet. And most importantly is their ability to innovate and push the technology frontier and take the lead as well as the market share as fast as they could. So price to book ratio is not relevant for companies like technologies, okay? But for banks, it is very relevant because the underlying assets are very valuable, right? They are loans, they are loans that gets interest, right, on it. They can be investments, they can be depositors' cash. So the assets are very valuable. And when the assets are very valuable, you will be able to use this price to book ratio. Okay, so banks' PB ratio is a very good metric to be used. And the second thing why PB will be even better than, say, PE ratio is because book value is a lot more stable. It doesn't fluctuate a lot throughout the years, right? And it also captures retained earnings. That means when a bank makes earnings that year, they pay out maybe half of the earnings as dividends. They keep the other half, right? So that the other half of the earnings actually increases the book value. So with the book value, you actually capture the cumulative retained earnings by the bank over the years, right? So if a bank is doing well, they should see this book value going up over time. All right, so that is why I think that using the price book ratio is one of the best metrics to use for banks. And how do we know whether a bank stock is trading at a cheap price or an expensive price? We can compare it to its historical range. Right, we can compare it to a historical range. So maybe you take a period of 5 years. Right, you can take a period of 5 years. You can plot the price to book ratio onto a chart. So it should look like it's ranging around some limits over here. All right. So let me explain how this chart gets derived. And this blue line over here. This is the price to book value. Okay, this is the price to book value. Right? Why does it go up and down? Because the stock price changes every day. Right? So when the price changes every day, the whole price to book ratio will change every day. And the book value, I usually take once a year. That means I follow the annual report book value. Right? So the book value doesn't change for entire year. And then the next year it changes, and then the third year it changes, fourth year it changes, 5 years, the fifth year it changes. So over a period of 5 years, the book value only change 4 times actually, right? And then the price itself will change every day. That's why you see the fluctuation that's been plotted over here. I'll share real examples later, right? But I just want to explain the concept now. And when the price to book ratio is high, means it's expensive, right? When the price to book ratio is low, means it's cheap. Okay, and typically analysts, what they do is that they will plot the average price to book, right? So for example, this bank, for the past 5 years, what is the average price to book it has been trading around? Okay, so you can actually draw a horizontal line to gauge where the price to book ratio is. And then after that, by using statistics, you have this concept called standard deviation, right? So let's say it deviates away from the average by 1 standard deviation, right? You can draw another line. Okay, and then you can also be a -1 standard deviation on the other side. It can also be +2 standard deviation, -2 standard deviation, depending on how many lines you want to draw. Okay, but that is essentially the concept. And usually people want to buy a bank stock when it is closer the 1 standard deviation at least, sometimes it can be -2 standard deviation. So these are places where the bank stocks are considered cheap, right? If they are in the middle, average PB, then they are considered fair value, right? And if they are trading around 1+1 standard deviation, they are slightly overvalued, right? So that is how you can find a point of entry for some of your favorite bank stocks, okay, by using just a very simple price to book historical range to give you some indication. All right. Okay, so then we move on. Those are more numerical metrics, okay? But we know that investment is not just pure numbers. You also need to look at the business model, and that's where the qualitative analysis comes in, right? How are the banks? How is this bank compared to other competitors, right? Because every country don't just have one bank. Okay, every country has many banks, and they have different level of competition, different level of strategy, and the market share is also different. All right, so it is good to assess who is the leader, who are the smaller players, and where the competitive advantages lies in. And then we also can look at the geographical exposure. All right, because some banks may not just be in their domestic market, they can expand beyond their domestic market in the region or even internationally. And product segments, like what I mentioned in the initial slide, I said that the bank can also skew towards a different kind of a segment. Some may do more loans, some may do more investment banking kind of deals, right? So like Goldman Sachs will be a lot more investment banking rather than taking loans and things like this, right? So banks may have a different expertise or a different focus area, right? So that will also make them stand out, and whether they have an advantage in that area compared to the rest. And we also want banks to grow over time, right? What are the growth opportunities? And one of the hottest thing that the banks are moving into is the fintech, right? To infuse more technology into their operations and to make it more efficient and faster, and more for people who are nowadays more mobile, right? Using your phone a lot more. People don't really visit the branch of the bank, right? You want to do all the transactions via online, right? So that could be an opportunity, but at the same time, it can also be a threat to existing banks who refuse to innovate, right? Then they will only serve the older generation usually, right? The younger generation, they will be a bit more irrelevant, and as the generation comes up, you don't get this new opportunity, you might be obsolete eventually, and your business will shrink, and you may even risk going out of business, right? So these are some of the qualitative analysis that you need to analyze besides just using those numbers, right? So that will give you an extra insight to which banks are more relevant for your portfolio. So now I'll move to the second part, which I will introduce the local banks in Singapore, right? Not sure how familiar you are with them. I believe that UOB is something that probably the Thais would at least have a little bit of recognition, because UOB presence in Thailand is the highest among the three banks, right? Or three Singapore banks. Okay, so let's start with the first one. This is DBS. It is set up by the Singapore government in 1968, and the bank was supposed to serve the industrialization projects, right, and the development project, because Singapore just get independence in around 1965, and the government wanted to build up the economy, and the industrialization was one of the major plans they wanted to kickstart, to create a lot more jobs, right, and urban development to create more housing, for better housing for the locals, right, and all these need money, right, and what else if you don't create a bank to fund all these projects and create all those loans that make it possible, right? So that was how this DBS, or the full name is Development Bank of Singapore, right? So that was meant for that purpose. And eventually they did well, and they diversified more, and they grew over the years, and they became the largest bank in Southeast Asia by assets, right? And it's also the largest Singapore stock that's listed on SGX by market cap, right? So the history isn't that long actually, right? So it's for less than 50 years, but they managed to be the biggest in the region. So a lot of great execution and strategy that is being done by the bank itself. And today it is still largely owned by Temasek. Temasek is a Singapore sovereign wealth fund, right? So it's still about 29%, almost 30% owned by the government. So some investors, they like government backing because they feel that if anything wrong, the government will always step in to save the company, right? So some investors prefer this, right? But I don't think this is the only factor that you consider, right? As we mentioned, the numbers, the qualitative analysis are important as well, right? This is just a bonus point. Okay, and the second bank that we're going to talk about is the OCBC, right? Stands for Overseas Chinese Banking Corporation. It was formed a lot earlier than DBS. It was formed by the Chinese business leaders, and that's why the name Overseas Chinese, right? Because there were a lot of immigrants from China that went into that gone into Southeast Asia, right? And some of them prospered after running their business, and then they saw opportunities in the finance sector. They started to create banks, right? And of course, in those days, the banks were very small, and they eventually merged. OCBC is a merger of 3 banks in 1932, right? And then there were more acquisition and expansions over the decade, and especially during 2001, they acquired Keppel Tatley Bank. It is one of the 5 largest banks in Singapore then, and they acquire it. And there is more story why this happened, which I'll share in two slides later. The third point is that in terms of the ownership, the Lee Foundation and the Lee Kong Chen descendants. So this is the one of the Chinese business leader that have really built up this OCBC bank, and they have a substantial stake even until today, right? They still have a combined 17% stake. And I don't know, now it's probably the 3rd or 4th generation that is running the family office, and as well as the foundation that they are in, right? So they have very illustrious history in terms of almost 100 years, right, of existence. Okay. And the third one is UOB, which is also formed around the 1930s. It was led by this guy called Wee King Chiang, another Chinese business leader in Singapore. And they also went out to acquire a lot of other banks, as mentioned over here. But the largest acquisition was OUB. So OUB was also one of the largest 5 banks, right? So there was indeed a consolidation in the banking sector in Singapore, which I'll share a bit more in the next slide. And today, the descendant, Wee Cho Yao, still owns 18.5%. He is one of the richest men in Singapore, in the top 10, right? And the son, Wee Chong, is the current CEO, right? So you can see that the 3 banks are owned by the government or very powerful business leaders, right? Since generations and generations before. Okay, I would say that they are pretty well managed. They're pretty much the same. Because in Singapore, the Monetary Authority of Singapore, MAS, the central bank, has a lot of regulation that make sure that the banks are properly behaving. Okay? They don't do a funny business out there. So the way I see it is that the 3 banks do not have much differences, right? Except for some of their expansion strategy in the region. The approach may be slightly different, but in terms of how they operate in Singapore, the 3 banks are very similar. All right. So why we ended up with 3 banks in Singapore was because in 2001, the government wanted to open up the banking sector. So they started to grant licenses to foreign banks to come to Singapore to open business. And they felt that the local banks would not be able to compete if they allow the bigger players to come in, right? They will be outcompeted. And they encouraged the local banks to merge so that they become bigger and stronger, right? So that was how during 2001, it kickstarted a series of a big merger. OCBC acquired Keppel Tatley, which I mentioned just now, and UOB acquired OUB, right? So last time there were 5 big banks, okay, the 5 largest banks. And now we only have 3 local banks. And that's how DBS, OCBC, UOB survive until today, after 20 years. That was critical point in Singapore history, right, that this merger allowed. And prior to that, it was also because during the Asian financial crisis, right, which started in Thailand and it spread across the region, Singapore was hit as well, and the banks were not as solid as they were, right? So there were a lot of policy changes, and I believe this consolidation is also part of the plans to make them more resilient and to make them having more capital backed by it rather than split out in many small banks, right? So this is one of the measures that the Singapore government decided to move towards, which I believe is similar to even Thailand or even in the region. There have been consolidation 20 years ago, just a few years after the 1997 financial crisis. All right, and these Singapore banks, I give you some statistics how important they are to the Singapore economy. We have an index, right? We call the Straits Times Index. This tracks the overall Singapore stock market, just like the S&P 500 in the US, right? So this is the equivalent in Singapore. It's made out of 30 stocks, okay? Because Singapore is not a very big country, right? So index only 30 stocks. And out of these 30 stocks, the three banks, DBS, OCBC, UOB, is almost 50% of the entire index weightage. All right. So this just goes to show how important the banks are. They are the pillars of Singapore economy. All right. We position ourselves as the financial center, right? And definitely our banks must be big. If the banks are not big, then it's very difficult to handle a lot of that kind of financial transaction that involves in the financial center, right? So all three add together, their market cap weightage in the Straits Times Index is 43%. The other 27 stocks is 57%. Okay, so you can see that the three banks are really big relative to the rest of the companies in Singapore. And if we look at the Southeast Asia banks by total asset, this was published by Forbes Global 2000 May this year, right? And you can see that the three local banks are the top in terms of the amount of assets, right? DBS is number 1, OCBC is number 2, and UOB is number 3. All right, and then the rest are Malaysian and Thailand bank. Okay, these three countries form the largest banks in Southeast Asia. Right, so you should be able to see a lot of the familiar names, right? Your Bangkok Bank, Kasikorn Bank, Krung Thai Banks, SCB. So these are the ones in the top 10, right? And the Singapore ones are the top 3. Okay, so they are relatively larger in the region as well, not just in Singapore. Okay, and let's look at some stats. So now let's apply some of the metrics that I mentioned just now, right? Remember the net interest margin that I'm talking about. We want net interest margin to be high, but you can see over the last, this is a plot of about 15 years. It is about 15 years. The black line is DBS net interest margin. The red line is OCBC net interest margin, and the blue line is UOB net interest margin. So you can see the net interest margin has been falling, right? So this is not a bank issue, right? This is a global effect of a low interest rate environment that started from the US. After 2008 financial crisis, the US went on a money printing spree, right? The quantitative easing, which is still happening until today for the past 13 years, right? It's been pretty amazing, all right? And the interest rate just keep falling, and naturally banks' net interest margin will fall as well, because the rates that they lend out would have to peg to the overall interest rate that's out there, right? So this is not a problem with the banks. I think this is a global issue. I will also believe that Thai banks also suffer the same issue, right, of falling interest rates. So that's the first one. And the second one is the non-performing loans. And in this case, the three banks have done very well, right? You can see they used to be very high, right? You have UOB, OCBC almost 10% at the start of the century, right? Just after the Asian financial crisis. So that's why I believe that a lot of the policy was shaped towards in improving the loan quality of the banks, and they managed to bring it down. Right, they managed to bring it down, and then the great financial crisis happened in the US, so you can see a little bit of bump up there as well. But after that, it was pretty much flatline and stable. Just about 1+% non-performing loan, so it's pretty impressive. It's almost a 10 times reduction from 20 years ago. Right, so the non-performing loans ratio has been this way since even the 2008 financial crisis. Right, so they managed to really improve the loan quality over the decade. And the third one is the capital adequacy ratio. We can also see that it is pretty healthy and stable for the past 11 years. Right, it's pretty much flatline. Okay, there is a bit of bump here because of the great financial crisis that happened in the US. Right, and the good times with a lot of lax lending, right? So the capital adequacy ratio also went down. There was a lot of demands for loans, and then after that in 2008, the capital adequacy ratio shot up, probably because banks were more afraid to lend out, and they try to make sure they had enough reserve in case more bad debts come, and they weather it, and then the capital adequacy ratio just maintained at a requirement. Right, they are very close. You can see their numbers, whether whichever metric, net interest margin, they're very close, right? In terms of non-performing loans, they're almost together the same. And in terms of capital adequacy ratio, is also pretty much the same, right? Between about 17 to 19%, it's just a 2% difference. Okay, so the three banks are very largely run similarly, I would say. Okay, and next, let's look at the dividends, right? Despite all the crises that happened, we have in the last 20 years, we have SARS in 2004, if you remember. There's financial crisis in 2008. There's also, the 911 issue in 2001, COVID last year. Despite all these things that has happened, okay, Euro crisis, there's some other smaller crises that happened throughout these 20 years. Despite all this, the three local banks managed to give dividends every single year, right? They didn't skip a year. Okay, the SARS they gave, financial crisis they gave, they just gave less, okay, but not much less. COVID they gave not much, a bit more, but still not a big difference, right? And the COVID was because the central bank, the government asked them not to give too much. They actually kept the dividends. Otherwise, they can actually give more. Later, I'll share with you, COVID didn't harm the three banks at all. Right, it's as though the COVID has never happened for these three banks. Their business actually boomed. Okay, they made more money in COVID. Not say they made more money. They took a hit, but then the recovery was very fast, right? And then they just made more money than before, especially this year. Okay, they found out that a lot more people were willing to buy wealth management products. I would say that because the COVID was a bit uneven in terms of its impact, it doesn't impact the rich people more than the poor people, right? So that's why the rich people still were able to deploy a lot of their capital to the stock market, and the stock market has been fabulous for the last 1 year. They make even more money, right? So it is unfair a little bit in life, right? But that's how the way it is, okay? And DBS, right? This is DBS dividend per share, right? You can see that it's not consistent growth, but overall, it has risen over the years, okay, for the last 20 years, right? Imagine 20 years you bought a stock, it was giving 25 cents per share, and now it's giving about 80 cents per share last year, right? This year is higher. Okay, last year it was giving 80 cents per share, and every year you get dividend, and the trend is rising, right? Overall. OCBC, same thing. You can see over the past 20 years, they have been giving dividends, and OCBC is even better in the sense that the dividends are rising. All right, there is no 1 year that they really cut except for COVID. Okay, you can see every year is either stable or either it is the same as the last year, or they raise the dividends. Right, you can see. Okay, for a good 19 years before COVID happens. Right, so they have been raising dividends for many occasions. So this is also another sign that their growth is very stable. Their business is very resilient. Okay, and this is UOB, a bit more jagged. You can see, right, not as smooth as what we saw in OCBC, but the general trend is also on an uptrend, right, in terms of its dividend distribution. Okay, and same thing, COVID, the dip is to be expected, right? So why did the COVID dividend went down was because the Monetary Authority of Singapore, the government, the central bank, capped the dividend. They told the banks, you cannot give more than 60% of what you gave in FY19. Okay, it's not that the banks couldn't give. The banks could actually give, but they just want to make sure that there's enough reserves, right? The capital adequacy ratio consideration, and they just ask the bank to keep the money first. Right, and this year, 1 year later, July 2021, they lifted the restriction. So investors should expect the dividend to go up again for these three banks. In fact, that has been the case. Let's look at the first half 2021 dividends. Right, DBS, it seems like it's flat, but the 3Q results show that they have raised the dividend by about 20%. Okay, I just didn't include the 3Q ones over here, right? Because they just announced only, not just probably like 1 day ago. OCBC has raised the dividend already by mid-year, right, by 57%. UOB has also raised the dividend by 54%. Okay, so you can see that the COVID didn't impact them much. So even when they held back some of the dividends last year, this year they are willing to give back more. Right, so I think that this again proved that the banks are resilient even in a very unprecedented pandemic that hurt the entire world's economy. They bounced back really fast. Okay, so they're resilient. In the COVID, let's compare the COVID numbers, right? FY20, this is where the COVID happens, and FY19 is pre-COVID. Okay, so let's compare, right? This percentage compare within 2020 and 21. For DBS, the revenue dropped about 0.3%. OCBC 7%, UOB 8%. Right? It is not like suddenly 50% drop in revenue, and then net profit get hurt a lot more, right? 26%, 33%. But it is not something that is damaging to their business. Right? In fact, they are still profitable, just less profitable. Okay, less profitable by a quarter to a third compared to pre-COVID period. But this year they bounced back. All right. And now let's look at the price to book range for the three banks. I plot a longer period. Instead of 5 years, I plotted 10 years. I use annual book value. Right? If you use a quarterly book value, the plot will be slightly different. Right? The conclusion will be slightly different. So this is the average price to book ratio in the past 10 years. This is +1 standard deviation. This is +2 standard deviation, -1, -2. So if we see that these points are very cheap, these points are still okay to buy, right? But now DBS is trading around that 2 standard deviation above the average. So it does look a bit pricey for DBS. Okay, and because they're also the biggest bank in Singapore, they are the most recognized. Investors also tend to favor DBS compared to the other two banks. They usually DBS trade at a premium compared to the other two banks. But to me, the three banks are run very similarly. All right, OCBC is cheaper. You can see that it's trading at -1 standard deviation. This is -2. Right, this is average. Okay, so OCBC is still at a pretty good buy price, right, compared to DBS. And UOB slightly above the -1 standard deviation, right? But again, it's not as expensive as DBS, right? So I would say that among the three banks, OCBC looks the most attractive in terms of the valuation. So that's how you can use this metric and decide how you can place an entry to the bank stock that you like. All right, so these are just the overview comparison with some other metrics, okay, based on these prices. Price to book for DBS is about 1.6, OCBC 1.1, 1.2. I'm using the annual last financial year book value, right? So it's a little bit higher, right? If you use the quarter one, I think it should drop by about 0.1 for all, but relatively it still looks the same. PE ratio 14, 11, 14. So it just again shows you that OCBC is cheapest by price to book, cheapest by PE. And in terms of the dividend yield, this is trailing 12 months dividend yield, 2.7%, 3.4%, 3.6%. So UOB is slightly higher, but OCBC is not far as well, right? So I would think that OCBC is the most attractively priced, considering that they are not too far in terms of their performance, and fundamentals are pretty strong as well, right? I think there might be some of you might be thinking, so why is OCBC trading at a cheaper price, right? So I do think that there is some consideration, which I'll share a bit more later, right? Which is the geography segments. So DBS, you can see that they are regional. They don't just have a business in Singapore. Of course, Singapore is a majority revenue contributor, right? But they have made inroads into other countries as well. So for China exposure is about 25%. Okay, so they have China exposure. 25% of their revenue comes from China. Other South and Southeast Asia, that means including India, is about 7.5%, and rest of the world is not that important, right? So there are actually two important markets, Singapore and China, for DBS itself. And for DBS, they have expanded via acquisition. So recently they acquired an Indian bank, Lakshmi Vilas Bank. Okay, so I believe that their strategy is to increase the India exposure. Okay, which is a big market, right? So you can see the strategy is to go for very huge markets like China, like India. That is the DBS kind of strategy. They particularly bought more local banks like Shenzhen Rural Commercial Bank. They bought a 13% stake. So you can see a lot of their expansion focus or efforts are in China and India itself. All right. And the next one is OCBC. Okay, OCBC, same. Singapore is a majority revenue driver. They have more Southeast Asian exposure, right? They have Indonesia, Malaysia, right, which make up to be about 24.9%, also about 25%. Okay, and for China, it's about 15%, 16%. Right, the rest are not that crucial. So for OCBC, is more regional. It's more Southeast Asia focused, right? With a tinge of a China expansion, but they have also sound out that China is their next big goal. Okay, they bought the Wing Hang Bank a few years ago. All right, and they have set up Hong Kong as their Greater China hub. Okay, and then Singapore is the Southeast Asia hub. Right, so you can see that they separate this out. That means that it is very likely that is their focus of their strategy, and is to tap into especially the Greater Bay Area development that is happening in China, the GBA thing, right? So the combination of over 10 cities in China, South China, to form a very big merged city metropolis, right? So that is the market that they are trying to grab to grow their China pie. So you can see even OCBC also have this kind of expansion plans, right? And the third one is UOB, and Singapore is their main business again, right? It's very similar to the three banks. It's only the overseas exposure that's different. All right. So UOB have even higher Southeast Asia exposure, right? So you even have a Thailand exposure. About 11% of the revenue comes from Thailand, 12% come from Malaysia, 6% come from Indonesia. So if we add it together, it's about 28%. Okay, 28% in Southeast Asia. That makes UOB the largest, having the largest exposure to Southeast Asia compared to the other two banks, right? So just recall a little bit. DBS is more into outside of Singapore, is more China and India, and for OCBC is Southeast Asia, right? Particularly Indonesia and Malaysia, and then expanding into China. All right, and then for UOB, you can see that they have very low exposure to China. Haven't really hear any news about expanding in there in a big way, right? Of course, they set up branches there, but it may not be a very key focus of their expansion. It seems like the regional Southeast Asian markets are still their mainstay. Okay, so that gives you a bit of sense that the Singapore operations are similar, but the overseas strategy, expansion strategy, are pretty different, right, for the three local banks in Singapore. So it also depends on which region you think that they have a high chance of succeeding, which region gives a higher potential growth to the companies, right, to the banks. I do think that in the next 10, 20 years, some of their performance will start to diverge because of their overseas exposure are all different, right? Okay, in terms of business segment, this is the product, different product revenue, right? Retail, wholesale, banking are the core drivers. That means banking accounts, consumer credit cards. These are the retail business. Wholesale are the ones that they deal with other banks or businesses. All right. So these two are the core, right? You can see their consumer one is the light blue one. This is consumer. Okay, and then this is the wholesale, right? This is wholesale. Okay, and for OCBC, it is unique because they own another insurance company called Great Eastern, which is also a listed company in Singapore. So OCBC has this insurance, right? Whereas for DBS, they don't underwrite their own insurance. They don't have their own insurance products. They are merely selling insurance product from another insurer company, right? So they are a distributor. Okay. Likewise for UOB, they don't have a insurance arm within the bank itself. And for DBS OCBC, they also have treasuries markets segments. That means the bond market, right? They are a bit stronger in that sense as well, right? Whereas you can see UOB is very focused more on the retail and wholesale banking. Okay, the rest are very small. Okay, whereas for OCBC and DBS is a bit more diverse. right? It's a bit more diversified. Okay. So all in all, I believe that there are a lot of good tailwinds for Singapore banks that would give them an advantage in growing in the next 5 to 10 years, right? So first of all, the most immediate will be the economic recovery, right? So now Singapore is opening up. We are not living with COVID-0 anymore. We are okay with cases as long as the healthcare facilities are not overwhelmed, right? Because after all the vaccination, most people do not have any symptoms, even if they have contracted COVID-19. And I believe that Thailand also want to open up. We also want to connect with Thailand. I also want to go Thailand. Okay, it's been a long time since I went to Bangkok. Still have a lot of other places I want to go. Right, so I do think that a lot of the countries have believed that it's time to open up the economy. Right, and it's opposite to what China is going. Right, China still imposed the COVID-0 kind of a policy, but pretty much the rest of the world we are trying to recover. Right, we're trying to open up. Europe, US have already opened up. Okay, now it's the Asian side of the house, right? So I do think that in the next, even within the next 1 year, we should be able to see more economic recovery. And when people start to travel, when people start to go out to spend more, your transaction fees will go up naturally, right? So for example, if I get one of the local bank credit card, I go overseas, I start to swipe paying with credit card, then the banks will get more of these fees as well, right? So I think that all this economic recovery in the short term will already give a boost to the local bank stocks, and higher loan book value, lower bad debts, because business start to make more money and they also want to expand. They may borrow more money and they will have earnings and profits to repay some of these debts they have borrowed before as well, right? So that is also one part that will increase the bank revenue too. Wealth management, right? Because markets are still good. Okay, the appetite for investing is still high, and banks will be able to sell more of these wealth management products. Especially the past 1 year result is good, right? That gives investors confidence that I should put in some more, make my money work harder. So all these activities will come after the economy gets reopened and giving a sharp boost to the bank's revenue and profits. And we already have been seeing it. The improvement has already come in, right? And I believe that this improvement will go on further because we haven't really reopened by much, right? So it should be able to bring in even more revenue for them. And the second thing is that there have been talks about rising interest rate. This is not confirmed yet, but a surprising move by our central bank was that they increased the strength of Sing dollar, and that is almost equivalent to trying to taper, trying to combat against a possible rising inflation rate, right? So if the inflation rate continue to go up, then it is possible that the world economy around all the big countries, right, will also start to increase the interest rate to combat against this inflation rate. It's not confirmed yet, but it seems like that there are some talks of this move. And when interest rate increase, then the banks will have more room to play around with their interest margin, right? It should also expand as well, okay? Because they can now lend out even higher interest rate. That gives them the moral high ground and also the ability to increase their interest on the loans that they make, on the credit, on the car loans, housing loan, all this all can increase. Business loan, all the interest rate can increase. When they do that, then they will be able to increase their margin as well, right? So that is also another positive sign for the banks. And then the third one is more long-term, which is the fintech opportunities, right? The three banks are also looking to digitize their business, right? And Kosin was sharing with me that SCB has also made a very big reorganization to SCBX, right? So there is this opportunity for the banks to digitize themselves, digitize their solutions to the customers. And they also talk about even having cryptocurrencies as part of the banking operations. So I do see that in the long term, the banks are unlikely to be disrupted as long as they adopt some of these fintech opportunities, right? If they, of course, stay in where they are and they don't want to improve, they don't want to change, then the chances of them getting obsolete is higher, right? So they can change the threat into an opportunity if they want to do so, right? So I do think that based on these three things, okay, in the short term, in the medium term, and in the long term, okay, the banks have a lot of positive things that's going around, them, right? So they make very good investment, and they have proved in the past how resilient they have been. So now let me share a little bit more about the digital banking kind of things, right? I think it's similar in Thailand, it's similar in Malaysia, similar in the region, or even in the world, right? The central banks or the governing body are very keen in pushing for digital banking. And in Singapore, it is we just given out 2 digital banking end of last year, announced early this year, right? We have 2 digital full bank license. That means they can do consumer, they can do wholesale, right? They can do a full suite of this operations, right? They have not launched their products yet, but the license have been given. One is a Grab Singtel consortium, right? Grab is the ride hailer. Probably, I don't know whether there's Grab in Thailand. Okay, it should have, right? Because they have a Southeast Asia exposure. So they also have got the license in Singapore to operate a bank together with Singtel, right? Singtel is the largest telco company in Singapore. And then C, this is the e-commerce, Shopee, right? Probably pretty popular in Thailand as well, right? Not just in Singapore, in the region. And they also got a full digital banking license as well, right? But they have not pushed out any products yet. And I think it will take some time for them to ramp up. And the way I see it, it's not so easy to take business from the 3 banks, right? Even though they are very solid companies, very worthy contenders of the banking sector, but they will take a long time to learn, right? They also need to poach a lot of experts from the current banks or even from foreign banks to make it work. And they have not been proven through crisis how to manage it, how to manage those stuff. So I do think that they will take many years to even get to where the 3 banks' expertise is, right? But they will be worthy contenders. Okay, they will be worthy contenders, and the 3 banks are not sitting still, which I'll share a bit more later, right? And then they also gave out 2 digital wholesale banks, okay, non-consumer. One is a consortium from China, and the other one is also from China, Ant Group, which is part of Alibaba. All right, they are known for their fintech abilities. One of the sexiest fintech companies in China or even in the world before the regulation came in, right? Otherwise, they've been listed all along. Okay, so these are what's happening in Singapore. You can see there is some form of new challenges, disruptors in the banking sector. All right, but I don't think they will pose a threat anytime soon. Okay, and then the 3 banks are also transforming, right? DBS announced they have gotten a license for cryptocurrency transactions in Singapore, right? They have launched a crypto exchange and custody service, not for retail, but for their higher net worth clients as well as for businesses, right? So you can see they are not just sitting there and wait for things to happen, and they have already moved, and they are the first bank to have adopted cryptocurrency in their services. OCBC also have their robo-advisors. They also try to keep in touch with the younger generation, right? People who don't want to meet an advisor, physical human advisor. They don't mind just placing automated trades online via the app itself. So the banks have also expanded a lot of all these newer products, newer delivery methods to entice the younger generations to come in, and they keep the investment amount low, the bar low, the fees low, so that why would people want to go for another competitor who is not proven and yet it's the same fee if I go with a more established one, right? So there is some price competition over there, but they are again not sitting still. They are doing something to rejuvenate their business as well. And then the third one, UOB, right? They started the Tomorrow Bank. Okay, I'm not sure whether you guys have an account with them. All right, they did more this kind of fintech business in the region, especially in Thailand, right? It's like they use Thailand as a test bed for a lot of all this technology initiative. Not so much in Singapore. This Tomorrow account is not available in Singapore, but it's available in Thailand. So I don't understand why. Right? So they make it more fun. You can see the colors they use. They try to appeal to the younger generation, right? They realize that they need to create a new brand. If they use a existing brand, it only have a big mind share with the existing customer, but not with the younger customers, the Gen Y, Gen Z kind of customers, right? So they create a new brand. Just like in Goldman Sachs in the US, they wanted to create a consumer banking brand. They didn't use Goldman Sachs, right? Because Goldman Sachs was known more for high finance, right? For merger acquisition, not so much for retail banking. And they created Marcus, right? A new brand, and they partner with Apple to do the distribution, right? So these are the concept that existing banks, incumbent banks, can also adopt and take on the challenge, right? And it might be a new opportunities for them. Okay, so in summary, this was what I shared, right? Just want to recap some of the points. So the first part was that I shared with you what are some of the ways to analyze banks using net interest margin, non-performing loans, capital adequacy ratio. These are the important ratios when evaluating banks, right? These ratios are not relevant for majority of companies, right? Out there, you don't talk about net interest margin for manufacturing company. You don't talk about non-performing loan for semiconductor companies, right? So these are very pertaining to the finance sector, especially the banks, insurance as well. All right. And then I also shared that using price to book, because the asset value for banks are very high, right? So price to book become a very good indicator, valuation tool for you. And I like to compare with historical range to tell me, whether point in time is this a good entry level for this bank itself. And it's a lot easier to use compared to, say, doing discounted cash flow modeling. Requires more information about or more accurate guesses about the future earnings. All right. And then the third point, I talk about the Singapore banks. I introduced that due to the three banks and why we end up with three banks and how they performed through all the crises in the past, and they have been delivering every year dividends in the past 20 years, right? And some has been rising, like OCBC has been rising very steadily, but the other two, DBS, UOB, have also raised their dividends in many occasions, right? I also shared that Singapore banks are very critical to Singapore economy. They form the majority of our index, stock market index, right? Their market cap are very huge, and they contribute significant GDP to our economy. And the fourth is that they are not just in Singapore; they are regional, right? And for DBS, it's more India, China, okay, and for OCBC is more Indonesia, Malaysia, right, and a bit of China, and then for UOB is more Southeast Asia, right? And they have also embarked on technological transformation. You can see that they have throughout new initiatives, right, changes, and to keep on with the new trends in fintech, not just sitting there and wait for things to happen, right? And that's why, in conclusion, I believe that they are good long-term investment. The short, mid, and long term advantages are yet to be reaped, right? We talk about short-term economy recovery, we talk about the mid-term rising of interest rate, and then we talk about the long-term all these fintech opportunities that the local banks can also capture. So I believe that their dividends will continue to go up for the next 10 years, right? They have proved their resilience, they have proved their innovation, and then they have all the advantages that are coming in the next 10 years, right? So, and out of the three banks, I do think that OCBC would be the most attractively priced at this point in time, because it is the cheapest among the three banks, all right? Okay, so that is pretty much my sharing, right? And I'm open for questions. Anyone, any question? Feel free to just...
Okay, thank you very much, Alvin. Quite informative. Even some of them I don't even know. Didn't realize that the bank is actually contributes a lot in STI index, but it is quite a surprise. I didn't realize that it would have contribute that much to the index, like 43%. It's quite big. I've got some question here from the audience. Okay, I think let's start with the tough one first. Yeah. Okay. The tough one says, why should we invest in Singapore bank stocks? The reason is being that Thai banks, the valuation is pretty cheap. I would say cheap. Price per book is low. Low P, high reserve ratio, high CAR ratio. There's higher net interest margin. Low price per book value is like only half from what I'm aware of. That's all reason not to invest in Singapore bank stock because all the ratios that you just mentioned, certainly we are cheap on the cheaper side. And also we have no FX risk if we invest in Thai banks. So what makes you think that we should expand, our investing into Singapore banks?
That's the most important question, right?
It's quite tough. I consider,
So definitely there are a few points that we can talk about, right? So the Thai banks are relatively cheaper valuation, metrics are better, you get a better bang for buck, right? But I'm not sure whether you have also looked at China banks as well. They are equally cheap as well, like 0.5 or even below 0.5 PB, very dirt cheap, but they have been staying cheap for a long time. Okay, I think there are several reasons that happen. Before 2008 financial crisis, the whole world has always been very connected. That means if US go up, everybody goes up. But after 2008 financial crisis, it's a little bit different. US can go up, but the Asian market can go down. Right, there is a little bit of this thing that happened just after that, and a lot of people attributed to the money printing that's happening in the US, right? So that's one of the thing, and then the world just got disjointed, and that's why now you start to see that the banks, even in terms of their valuation across the world, has go out of whack. It's not the same. Some countries, their banks are more overvalued. Some banks in this part of the world is cheaper, right? So I do think that is one part of the phenomenon. All right, it could be a money flow issues, right? So then the second thing is that what I have seen in the last 14 years, okay, or at least the last 10 years, a lot of the expensive stocks, okay, in the US especially, right, has just keep going up and up and up, right? And then you look at Asia, oh, it's very cheap, I should buy Asia. But then Asia just keep having a slump compared to US. It just keep going up. The valuation, you think that it's very expensive, you can just go up another 100%, right? So the world somehow has become more extreme in terms of the investment, and investment dollars are chasing after quality stocks more than before. And that explains why value has underperformed for the last 10 years. Right, Asia less so. Like Asia probably underperformed for the last 3 to 4 years in terms of value strategy. But in the US, for the last 10 years, if you do a value strategy, you severely underperform. Right, so money seems to be rushing to the quality stock, and they just keep piling on it, So the thing that I want to share is that from a growth perspective, I would think that the three Singapore banks would have a better growth prospect in the region, right, or even in India and China as compared to, say, Thai Bank, right? My understanding is Thai Bank, from Kosin, is that Thai Bank is still pretty much localized, right? Of course, they also want to expand in the region, but I would say that the three banks in Singapore has already done so. They already have footprint in other markets. So in terms of that qualitative aspect, I think some investors are willing to pay a higher premium for these Singapore banks, and that's why their valuation looks higher. Their numbers don't look as good as the Thai banks. So it's back to where the value versus growth kind of investing strategy that you're in, right? So if you're a value investor, I think it is not wrong. You buy the cheaper ones, right? Whether is it Thai banks or even China banks. Okay, I do think that they are more value than Singapore banks or even the US banks, right? But if you're more of a growth investor, then I think looking at the future prospect, where are they going to get their revenue increment? Where are they going to get their earnings increment? Where are they going to get the dividend increment? It probably has to come in from the regional expansion. So in that case, then I think that paying up for a little bit of that quality makes sense, right? So it is a difficult question, right? But I'll throw the question back to the audience, right? What kind of investor you are, right? Whether you're more value or you're more growth.
Yeah, exactly. I agree on your point, especially the diversification of their business model. Especially Singapore banks, they have already expand into the regional, many countries. Whereas Thai bank still limiting on most of the businesses still carry on, onshore. I think you made a good point. also the valuation. It depends on the style. I really agree. The next question, I think this one is much easier. Client asks, does MAS prohibited banks to do other business, just like Thailand? Yeah.
Yes, similar. So it was after again the Asian financial crisis. So Singapore banks used to have, like for example, DBS used to have a development arm, property development arm, right? And also because of the Asian financial crisis was because of the property market, right? One of the key reasons. So the banks were forced to divest all their property stake. Okay, but not just that. Any other thing that is not related to banking, even in insurance, underwriting, all those, they have to supposed to take it out. That's why the three banks doesn't have all the underwriting abilities right today. So property was one of the big arm, and DBS Land was spin off, right? Was eventually sold, and then they merged with Pidemco Land to form Capital Land. So that was when Capital Land was born out of this regulation because banks cannot do non-banking stuff. So without that move, Capital Land won't exist today, right? So it is similar. I think that is to reduce the risk of banks. This is one of the key lessons that the Asian markets, Asian government has learned from the Asian financial crisis in 1997.
Just out of my curiosity, will Singapore bank be making a brave move like Thai banks, the SCB that I've just shared with you, that they will actually setting up a new entity and then swapping the shares? I'm not sure. Will that happen? Do you think?
Yeah,
just curious.
I don't think it will happen. I don't think it will happen, right? So for what the SCBX do, right, is that they just put their original bank as part of the subsidiary of a bigger bank, so that they have like fintech arm that is under this new mothership, right? So that is their idea. Okay, I don't see that is likely to happen in the Singapore banks, right? Because they don't like to especially acquire fintech companies and then park it under their wing. They don't transform by acquisition, which I think why SCBX want to do that is because they want to acquire some other fintech companies and park it under the mothership, right? If that is the case, that structure is correct. It makes sense. But for local banks, they don't like to acquire to innovate. They like to innovate within. Yeah, so they want to have control over the full process. That is just how the way it is, because they do think that complying to regulation is very important thing, and they don't want to have another fintech arm then run into regulatory problem and then they have to explain to the government. So they want to have a full control over the process, how the innovation take place, right? Yes, it will be slower, but it is just their style, right? So I don't think we will see a DBSX, we will see an OCBCX, we won't see a UOBX. Like when UOB created a new fintech brand, it is still under the umbrella. They have full control, right? The Tomorrow brand. It is not a totally new fintech company that they started or they acquired.
Yeah. Okay. More general question, I think. Client asks, what are scopes of the service for those digital banks that you mentioned? Are they servicing only individual, or are they only servicing certain kind of business? Can you elaborate, because we don't have a digital banking license in Thailand?
So for, I think the top two, the full banking license will be more obvious because they touch the consumer. Right? They actually have two kinds of business. One is wholesale, which means they deal with other businesses or even other banks or institutions. Then the other one is to individuals or even companies who need direct loans from the bank itself. So I believe that it will be really a very different way that they will start it up, right? I don't think they will have like branches like what banks used to have. It's all going to be very digital. The Grab has already some services already, right? Like insurance. They distribute the Chubb insurance via their Grab app. They have robo advisor on Grab app itself, which makes a lot of sense, right? Because they already have very massive user base, right, that they can tap on. Okay, and they just need to create this kind of new products and just distribute. They already have a distribution channel. In the past, the banks need the branches to have distribution channel. Nowadays, it's on the phone. As long as you have users, you are able to tap on them very, very quickly. So that is one of the advantages, right? So these are some of the services. I think robo-advisor is always very easy to set it up. Insurance, in terms of distribution, not underwriting, right? Because they already have the user base. And card discount, they can create like their special credit card. They work with merchants. Grab already work with many merchants, so it's easy for them to grant discount. Maybe for C, if you shop on Shopee, you use the C Money credit card, you get discounts, right? So I do think that these are some of the more obvious ways that they can do it. Or like what Ant Financial did in China. If you have excess money, you don't withdraw out from your e-commerce wallet. You just deposit in this fixed D or this investment product. You get even higher returns. And what Ant also did was that those kind of loans, right? Instead of having credit card, right? Maybe credit card is obsolete. They don't even need that. They know your purchase history from Shopee, right? They know whether you have money to pay, right? And then they can just underwrite or grant you a loan at the point when you purchase something. So there will be a lot of all these changes that will come. They have to rethink the entire banking solution and make it as fast as possible. So I do think that in the future, credit card may be less relevant as a form of loans to consumers, right? So those kind of just-in-time lending just before you buy something, yeah. Now you have the buy now pay later kind of scheme that's out there as well, right? So we will see a major shift in banking solutions. And I just want to quote the DBS CEO. Oh no, not DBS CEO. He quoted Bill Gates. Bill Gates said something like, he said that everyone needs banking, but nobody needs a bank. Right? So what he's trying to say is that banking is necessary, but banks should be invisible. So I do think that in the future, this opportunity is that banks are just the background processor of all your financial needs. You don't actually know that they are around. You don't see their physical branches anymore. You don't see their presence anymore, right? They just work behind the scenes. So that is what banking is going to be.
Yeah, I agree. One day we should get there. Yeah, one last question, Alvin. What is the status of crypto trading in Singapore currently? Does bank really get involved? And can average person trade cryptocurrencies? Any tax arise from trading these cryptocurrencies? Yeah.
Good question. The bank's only DBS is involved in cryptocurrency, but it is not to the individual yet. It's not to the individual. But that said, individuals in Singapore can trade cryptocurrency, right? The Monetary Authority of Singapore, MAS, have allowed or exempt, right? That means they allow some of this cryptocurrency exchange to operate in Singapore, right? You can even fund the account in Sing dollar, right? Not necessarily using US dollars. So you can fund the account in Sing dollar, and they have exempt them from getting a license to operate in Singapore for the time being, right? So that means it is legally allowed in Singapore to trade cryptocurrency if you want to. There is no taxes because in Singapore there's no dividend tax, there's no capital gain tax. Okay, so that means that you keep whatever you make, right? But of course, you also can't claim any tax benefit if you lose. So it works both ways, right? So that is the way it is. In fact, cryptocurrency is very popular, getting more popular in Singapore. You start to hear more people get involved in it. It's getting easier and easier, more accessible as well, right? So I do think that it's going to be a major driver for the future development. How it will turn out, it is still anyone's guess. How important it will be included into the economy is anyone's guess. But it is also obvious that the Singapore government wants to be a leading country in cryptocurrency. So that is good news. So I do think that eventually the banks will, or the financial institution in Singapore will just go on it because the government has already said so already, right? Our minister have said it. Our MES chief have also just said it in the past 2 weeks. So they reiterate it. So this message will just keep going through. So I do think that Singapore believe that if they don't take on cryptocurrency, they are going to be behind, right? Yeah.
Yeah. So I guess that's about it. Yeah. So before we ending this seminar, I would like to thank Alvin for a very informative presentation, and thank you for your time to speak
Thank
to
you for
us
having
today.
me.
Yeah. So, well, personally, I believe that the knowledge that you have shared will help our investor in investing Singapore banking sector. We also would like to thank all the attendees today, and thank you for all the support in our product and services. And we will see you next time. Thank you very much. Have a good day.
Thank you.
Thank you, Alvin.
Good to speak to you guys. All the best. Good luck.
You too. Bye.